Hello everyone. As the title of the video likely suggests, the Fed recently had their meeting and decided to hold on rates. I'm going to be going over how this actually affects your investment portfolio and kind of again reiterating what's going on in the markets and what this actually means for you. So, today specifically, the Trump team put out notice and indicated that its retaliatory tariffs may not actually be as bad as first seemed, and that's why the market had a pretty positive reaction today, with some of the indices, such as the NASDAQ, actually being up 2% today. And so, what this kind of means is we're still probably going to be likely to see a lot of tariff threats in the future in terms of negotiating practices. So, again, look for Trump will announce a tariff he's looking to impose, and then he'll set like a due date for the 30 days. Probably the other country's president will come out and say the retaliation they're going to do if that goes forward, and then Trump will either decide whether or not at the end of that 30 days to actually impose that tariff. And if so, then the other country is likely to impose retaliation tariffs, and we're likely to see a steep market decline. Or he might, like we've seen in the past already, put out a grace period of, say, 30 days or another thing to try and negotiate with that president. Either way, the end goal is to get to a negotiation. If the president, of course, if President Trump does not give a grace period, then we're likely to see it go into another 30 days or so of both countries tariffing one another, kind of getting in a stalemate, not really doing anything except pushing prices up for consumers, and then he might eventually get some sort of negotiation. Again, it's kind of been a middle of the road review so far in terms of actually doing this. We're still very early into a Trump presidency, and I want to go over individual tariffs, but honestly, it makes it kind of hard with how fast these are pushed out one day and then, oh, never mind the next day, and how fast each country is giving proposals to retaliation tariffs or trying to overall win the trade wars that are going to be going on. Obviously, I don't think anyone is very pro tariffs. We're not trying to use them in any way to protect certain industries or anything of that nature or protect American manufacturing. We're simply, again, using them solely for the purpose of trying to negotiate, with hoping that other countries don't call our bluff and are willing to negotiate. So again, I think a lot of the hopes behind this was also Trump's been very outspoken about getting the Fed to actually cut the rates to, again, almost zero, which I went over in a previous video if you'd like to go watch more of the tariff specific stuff and why that is the case. But just to give the Sparks Notes version, he's hoping again to hopefully refinance the very large outstanding US debt. But recently, the Fed actually had their meeting and they decided to hold rates. So, really quickly, with the word recession being thrown around constantly in the news, it's going to be brought up more and more as this goes on and as the Trump team gets more aggressive with their tariff things. I'm going to kind of walk through how that would actually happen. So, in a high interest environment, I'm not saying we've actually kind of been steadily lowering it. It's still not at target, but it's almost there. In a higher interest environment, companies are significantly less likely to spend money. Now, what does that mean? Both from a hiring standpoint, any reinvesting, anything that costs money, they're trying to find more cost efficient ways and overall be significantly less risky. In addition, in high interest environments, individual investors, like normal people such as myself, are looking towards more risk free or at least less risky assets to invest in. And again, all of this does not necessarily do favors for the economy, but specifically with those large economies, they might be freezing hiring or slowing down the pace at which they're hiring and the pace at which they're expanding. This actually leads the unemployment to go up significantly, which, when the unemployment goes up, there's significantly less spending both on a company side and in terms of actual people trying to buy things or anything of that nature. This in turn will drop the GDP of the US, And in order for there to be a recession, we have to have 2 consecutive quarters of GDP droppage. So, again, hiring freezes, unemployment rate shooting up, there's not as much money being spent around and fueling the actual economy itself, and we could see GDP drop. So recently, the Atlanta Fed actually put out their prediction for the first quarter GDP growth, and again, this is without the tariffs. They had it at a minus 2.4%. So this wasn't actually due to any of the tariffs being imposed and trying to use that data. That'll come later on. This was solely due to the fact that there was going to be volatility from the tariffs, if that makes sense. But this doesn't actually count for the tariffs yet. This is just the volatile nature, and companies probably looking to adjust as they try and actually expect what's going to happen with these tariffs. I know in a lot of recent earnings calls, we've actually heard from large companies that they are actually putting together teams of their staff members to actually look at how certain tariffs on certain sets of goods they might need will impact their business and what pricing changes they need to do, obviously going up for the consumer. But overall, they have teams already in place that are looking at how these tariffs are going to affect. And when you have money being spent on that, you have significantly less money looking towards expanding it all, looking towards reinvesting in the business, or looking towards hiring. Additionally, one of the articles that recently came out is JP Morgan, which also does forecasting, raised its chance of recession to 40%, again, citing very volatile political concerns and very large, well-known political concerns that are going on right now. So, why did the Fed hold rates? Well, it's important for the Fed to maintain rates right in that 2.5-2% range so that our prices actually don't shoot up. And I know that sounds a bit counterintuitive because, well, how Trump ended up winning in a lot of ways was being the campaign for bringing the prices down. But in actuality, when we look at it, in the last year, eggs were up 60%, and that in a large way contributed to the figures that we're now seeing as to why the Fed is having to maintain rates. Because if they drop them all the way to zero, there's going to be more and more spending driving up more and more demand for products, which in turn will increase the price. So it's it's all connected in one way or another. And they kind of took a wait and let's see what happens approach, which again, Trump and his organization has been very outspoken against, but it is likely, again, that the Fed is going to try and wait out and see what's happening with the tariffs, what's happening with our trade allies before starting to cut. However, on a good note, there have been multiple mentions of potentially, again, similar to what we saw last year, multiple cuts somewhere in the 25 basis point to 50 basis point range, and we could likely see a couple before the end of the year. But again, I wouldn't hold my breath on those. I wouldn't expect them necessarily. They'll probably be an added positive as they look at job growth rates and all of the important data that goes into those major decisions. So that's kind of what happened with the Fed meeting recently. Again, Trump and his team, very outspoken, are kind of causing an environment where the Fed doesn't necessarily feel comfortable cutting rates yet, and especially not to what's being called for of them to cut rates to almost zero. That very much isn't likely in this time. That would be the case to try and actually avoid a recession, which we'll see if that actually gets toward any way of happening. I really don't see that happening. Instead, what I see kind of happening is as we get more into these tariff talks and as we the market kind of understands how these are working better and we have more actual examples of Trump from threatening tariff to completed negotiation, so probably a few years out, even if he's still continuing to try and do this, once we have more instances where he can actually point to, okay, remember this specific tariff when he negotiated that and it ended up going to this, then we'll have a better idea of how to actually price these. But okay, I think really what the important takeaway here is I typically don't like to look at things in terms of short term. So even Fed meetings that happen multiple times a year, I really don't like to try and invest around that, especially when you're going to be in a highly volatile market like now. If I made a video any single time I thought okay, there are signs that are indicating that the market's going to go down versus there are signs that could be positive, especially under this administration. There'd be multiple videos out every week. It'd be very contradictory. It'd be very hard to actually time any of that. And so, again, I would pitch that you are significantly better off investing for long term and investing through this administration, not trying to constantly try and find the best pricing available, but instead just spend your time in the market so you give your assets time to compound. Again, if you are really worried about the volatility, this would be a great time to look at maybe some fixed assets, maybe even some CD rates. I know they haven't necessarily been great the past few years, but again, that is just risk free. If you are absolutely terrified of what a volatile market could do, if you have anything coming up, say a retirement in just a couple of years or so, maybe try and look towards some of those fixed assets or CD rates or anything in that nature. I will say definitely try and look for anything above 3% or so. That's kind of the benchmark for inflation. And if you actually have assets that are below 3%, then you're effectively losing money. I was going to make a separate video on this, but why not? So, that being said, with the 3%, I brought this up before, but if you actually look at your savings account and that is your primary investment vehicle, you're effectively losing money year over year. Now, there are some high yield savings accounts that are actually larger than inflation. And if you want to try and gauge inflation at any point, there are plenty of statistics out on the St. Louis Fed website that I highly suggest you check. But in terms of investments, if it's not actively beating inflation, I wouldn't really consider it an investment. So try and set aside some money if you want to. There could be some great opportunities to actually buy if you do have large cash positions right now. Or if it's too volatile, simply look towards my personal is going to be a CD. Personally, try and shop CD rates and find the best place you can for your money. Okay, thank you.